There are many ways to navigate financial markets, but at Fincryptix we usually play with two approaches: on-chain and macroeconomic analysis. Interestingly, when these two data sets are combined, the results can give a more solid picture of market direction. For example, Michael Howell from Crossborder Capital and the Bitcoin layer created a way to read global liquidity that is somewhat different from the usual definition. The result? It turns out that there is a very strong relationship between global financial conditions and Bitcoin price movements. Howell said, liquidity is essentially the strength of collateral in the financial system. If the assets used as collateral are strong, banks can be more aggressive in lending and the effect on the capital market is wider. He wrote this idea at length in his book, Capital Wars. From there, the Bitcoin layer created the TBL Liquidity Index, a kind of thermometer to measure how healthy the global liquidity market is and how it affects risky assets, such as stocks and Bitcoin. And surprisingly, the correlation between this index and Bitcoin is now over 70%. The index itself is calculated from four main ingredients: US Treasuries, bond volatility, dollar movements, and global banking assets. If the number is above 50, it means that liquidity is growing, aka the market is more supportive. Right now, the value is in the safe zone above 50, which means liquidity is healthy enough to encourage risky assets. Furthermore, the Bitcoin layer also found a quarterly TBL liquidity cycle pattern. The pattern is unique because the ups and downs of this index often coincide with the peaks and valleys of risky asset prices. So, for example, buying Bitcoin or stocks when the index is at the bottom, the profit opportunities are higher. And indeed, if you look at historical charts, this pattern is quite consistent. Another factor that comes into play is US Treasuries, as they are considered a global risk-free asset. The movement of the 10-year yield has an impact on almost all asset classes. Since the Fed stopped raising interest rates in mid-2023, yields have started to stabilize. This stability makes the bond market calmer, hedging is reduced, and in effect, the stock and crypto markets become more comfortable as well. In addition, the recent U.S. debt policy is more inclined towards short-term issuance, which has the effect of adding cash to the market, meaning that liquidity is getting looser. Combined, there are three big boosters for the market right now: more stable bonds, a debt policy that doesn't make risk duration explode, plus the Fed's stance is starting to loosen up a bit. The SLOOS survey data also shows that bank lending standards are starting to ease, which is usually a positive signal for stocks and Bitcoin. And from the TBL cycle, the last bottom just happened to appear in early August. So it's only natural that many think the market has a chance to go up now. But yes, disclaimer first. There is no crystal ball that can guess the exact direction of Bitcoin. All this data makes confidence stronger, but the decision still goes back to each investor. Don't just capitalize on FOMO. Keep doing your own research and remember, this is not financial advice.